Source of unbiased information on 529 plans. Before we begin, I just want to take a moment to thank all of you for voicing your concerns about the President's proposal to tax earnings on 529 plans. We are pleased to announce that this proposal has been dropped, which means families can continue to benefit from tax-free earnings growth and withdrawals when they use a 529 plan to pay for college. As a parent and 529 account owner myself, I'm both relieved and excited about this news. Here today to answer all your questions is Joe Hurley, founder of SavingForCollege.com. Joe launched the site in 1999 while he was working as a CPA in Rochester, New York, and he has since published several articles in professional journals and is frequently quoted by the press. He is the author of 2 books, SavingForCollege.com's Family Guide to College Savings and The Best Way to Save for College, a complete guide to 529 plans. And he's also the editor of SavingForCollege.com's Pro Update newsletter. Thanks for joining us today, Joe.
Oh, my pleasure, Kathryn. Thanks for hosting today.
Sure.
You know, when we set up this webinar, Kathryn, we thought we'd be talking about this proposal and ways that it was going to hurt American middle-class families and what we could do about it to try to prevent it from going forward. And then yesterday, as you mentioned, the president backed down and said that this was no longer part of the budget plan going forward. And so we've also felt a big sense of relief. So we really don't have that much to talk about as far as the proposal goes today, but I do just want to mention what it was all about and how it would have impacted 529 plans and families trying to save for college. And because you never know what might happen in the future and other obstacles that may come along for families using 529 plans. So this proposal essentially would have rolled back the tax treatment of 529 plans to 2001. And at the end of 2001, 529 plans became tax-free. Before 2002, they were tax-deferred but not tax-free. If you took money out of your 529 plan for college, the earnings actually were taxable in those early years. There was a benefit because the earnings were taxed to the student on the student's tax return. So it was basically a way to shift the income from the parent to the student along with the tax deferral. If we had rolled back to 2001, though, it would have effectively killed 529 plans. It wouldn't have affected old contributions. Anything that you already have in the plan would still be tax-free when it came out for college, but any new contributions would become taxable. The reason why it would have killed 529 plans is not only would the taxes be a big burden on families saving for college, but also the fact that the income would go to the student, and students are now subject to the kiddie tax. So student income over a certain level is taxed at the parents' tax rates, which was not the case in 2001. So even though some families did actually use 529 plans before the tax exemption came along, it would be a much worse situation right now. So contributions to 529s would dry up. There's another impact that would have been felt by many, and that's on financial aid. Because right now, when distributions come out tax-free, they don't show up on your tax return. They don't have to be reported for financial aid purposes as far as the income goes in your 529. And so there's a huge benefit in using 529s to save for college as opposed to, let's say, a mutual fund that you sell in order to pay for college. A capital gain is thrown off on your income tax return, and that capital gain is reported on the financial aid application and can hurt quite a lot in determining your student's eligibility for federal financial aid. So under Obama's proposal, by putting the income back on the student's tax return, it would have severely impacted that student's eligibility for financial aid. So for those 2 reasons, 529 plans just would not attract new contributions, and they would just sort of dwindle in size over time as the old money was coming out of these plans. And at a certain point, states just can't keep these plans open if there aren't sufficient assets in these plans. Even if they try to keep them open, they would probably have to increase the fees in these programs because you'd have to spread those fees out over a fewer number of dollars in the plan. So it just would have had a very severe impact. And of course, that means that millions of families would have been affected that want to use 529 plans to save for college. They've been a tremendously successful program since 2001. We have about 12 million accounts across the country in 529s. Families are using the money to pay for college. They're being given an incentive to save for college in the first place. Many parents are involving grandparents in their 529 plans, or aunts and uncles. Family, friends even can contribute to these accounts. So it's a way to sort of reach out and get other people involved in saving for a child's college education, those people that would like to do that. You know, the rationale, I believe, for the original proposal coming from President Obama was because he wanted to target the tax incentives in other ways, namely the American Opportunity Tax Credit, which has been around for a couple of years now. It is a nice benefit. It's a tax credit for paying for college, but it really doesn't go that far. It's a $2,500 credit. His proposal would tweak that credit a little bit, enhance it in some ways, but not make a major overhaul. But a $2,500 credit is $2,500. Some students these days are facing nearly $2,500 in expenses every year just to pay for books and supplies at college. So you do need to save for college. And by killing the 529 plan, it would have really hurt a lot of middle-income families. The other odd result of this proposal, if it had come to pass, is that it would not raise any revenue, because if no one's making contributions to a 529 plan, there's no money to be taxed. And so the argument that it could be used to enhance the American Opportunity Tax Credit or to help pay for free community college, which is another one of President Obama's proposals, that just would not have come to pass. And it would have kept some other questions sort of in limbo out there too. Just maybe 2 months ago, a new law was signed that would provide 529 plans for disabled families, not to pay for college, but to pay for future disability expenses of that family member who is disabled. And so if this had come to pass, the proposal, then it would have really put that new 529 plan for disabled individuals in jeopardy. Who knows what would happen to that particular provision. So thankfully, the American people spoke very loudly. There was a swift reaction, a very intense reaction to this proposal. I'm sure a lot of representatives in Congress heard from their constituents that this was not a good idea. A lot of the media that came out was against this particular proposal. And so I think we can all breathe a sigh of relief and maybe even be thankful that more families now are aware of 529 plans because of all the publicity out there. And if you haven't started saving for college with 529 plans, maybe you're better convinced right now that this is something that you need to get started with. So, Kathryn, I'll leave it there as far as my preface goes.
Great. Okay, well, we'll go ahead and start answering some questions. We have a few that have been submitted, and you can also ask Joe any other questions by using the chat box, which you should see on the right side of your screen in the control panel. So, Joe, why don't we start by letting everyone know why the 529 is the best way to start saving for college?
Well, there's the income tax benefits are paramount with the 529 plan. The fact that this is a way to invest without paying taxes on your invested earnings, as long as the distributions are used to pay for qualified higher education expenses. As everyone knows, college costs keep going up, and over the last 10 years, the cost at public universities has risen an average of about 6% per year. So you'd like to invest, I think, just to keep up with college costs, never mind trying to earn more than the college costs go up. And so it's very difficult to do that when college costs are increasing by that level. If you had to pay taxes on your investments for college, then it would make it nearly impossible to keep up with college costs. So the 529 plan, first and foremost, is a way to help you invest and have a chance of keeping up with college costs. Another benefit is on the state level. You may live in a state that offers a state tax deduction or a state tax credit for contributions to a 529 plan. That's a tremendous benefit to you. It's a guaranteed return on your investment. So depending which state you live in and whether this deduction or credit is available to you, you should definitely look at how you might benefit from that. Most states that offer a deduction require that you use your own state's 529 plan. A few states do not. A few states give you a deduction no matter which 529 plan you use. And then there are some states that don't have a deduction or don't even have an income tax, where you should feel free to shop around for any 529 plan. The other major benefit that I talked about earlier was financial aid, the fact that 529 plans do not throw off income to be reported on the financial aid forms. And so income is assessed much more heavily than assets are assessed in determining eligibility for financial aid. So your 529 account, the value of the account has to be reported, but it's reported at a relatively low percentage. It's reported as a parent asset. Parent assets are assessed at no more than 5.64%, as opposed to income, which is assessed at as much as 50% in the formula. Some of the other benefits, Kathryn, for the 529 plan are great investment options. We're seeing really solid investment performance in 529 plans and very low fees in 529 plans. Over the years, fees have come down tremendously, where they should not be a deterrent for anyone looking to save for college with a 529 plan. And the reason fees have come down so much is because there's a lot of competition between the states and between the investment firms that the states hire to manage their programs, so that competition helps bring down fees, and also because assets have increased so much in these plans. We have $250 billion in 529 plans right now, so by achieving those large asset bases, the plans are able to knock down fees proportionately. So those are the essential reasons that I think 529 plans really should be of interest to families.
Okay, just want to say really quick, if everyone could ask their questions in the question box instead of the chat box, that would help. Okay, Joe, so you mentioned you get the tax savings if the money's spent on a qualified expense. Can you kind of talk about qualified expenses? We get asked a lot whether things like airfare or computers are considered qualified.
Right. There's a specific list of what qualifies for 529 tax-free distributions. So it includes tuition and fees. It includes any books, supplies, and equipment that are required by the school. It includes the expenses of special needs students. So a student, for example, who might be blind and needs to have a special tutor to help them with their classwork, those expenses of the tutor could be taken out of the 529 tax-free. It also includes room and board. There's a couple of extra requirements for room and board. Number one, the student must be at least half-time. All those other expenses, you don't have to be half-time, but with room and board, you have to be at least half-time. And there's a limit on how much can be counted under room and board when you're taking money from a 529 plan. So a student who lives on campus, it's generally what the school charges that student for living on campus for room and board. If the student is off campus, it's whatever the school determines is the allowance that the student should essentially set aside for living off campus. So every school is required to calculate that number for federal financial aid purposes. So you can simply ask the school what their allowance is, their room and board allowance is for off-campus students. And so it doesn't include, Kathryn, it doesn't include transportation. It doesn't include repayment of student loans. Currently, It does not include computer expenses unless the school requires that the student come to school with a computer. But that might change because there was a bill that was introduced in Congress just 2 days ago that would include computers as eligible expenses for 529 plans. So we hope that that particular bill will make it through and get signed into law before too long. Computers were actually included back in 2009 and 2010, but then the law that allowed that expired, and we lost that particular provision starting in 2011.
Okay. And now what happens, what are the taxes or penalties for spending the money on other things, such as a computer if it's not required?
Well, yes, if the money comes out of a 529 plan and you don't have matching amount of expenses incurred by the student, then that excess 529 money is what's called a non-qualified distribution. The earnings portion of that non-qualified distribution has to be reported on the income tax return, and unless an exception applies, it's also subject to a 10% penalty or a 10% additional tax. So you do have to be concerned about taking the money out and not using it for school, because now it becomes subject to tax plus this penalty. There are exceptions to the penalty, as I mentioned. Those exceptions include scholarships. So if your student gets a scholarship, you can take an equal amount out of your 529 plan. It's still a non-qualified distribution subject to income tax, but there's no 10% penalty. If the beneficiary has died or become disabled, those are other exceptions. If the beneficiary attends a U.S. military academy, essentially those are cost-free institutions, so you can take that money out without penalty. So you might want to look in that direction. Now, I should note that when you take your money out of a 529 plan, you designate where that money goes to. You can designate it to go to the student. You can designate it to go to the account owner, or designate it to go to the school that the beneficiary is attending. If it goes to the beneficiary or the student or the school, then the 1099 goes to the beneficiary. If it goes to the account owner, then the 1099 is sent to the account owner. And that determines who has to deal with that 1099 when they're preparing their tax returns for that particular year.
Okay. I'm going to take a question that came in from Marty. How can I tell which 529 plan is best for me and my situation?
Well, Marty, what you would do is probably start to do a little research and compare the different 529 plans. Start with your own state's 529 plan. The states, by and large, run very solid 529 plans. They're competitive with each other. You're not going to find all that much difference from one 529 plan to the other. You will find, in some cases, different investments and different investment managers. And so if your state doesn't offer an investment manager that you think will do a good job for you, you can shop around to another state where you believe you might get better performance on your 529 plan. My suggestion in some cases is, who do you have your retirement money or other investment accounts invested with? If you really trust, Vanguard, for example, you might want a Vanguard 529 plan, or Fidelity, or TIAA-CREF or T. Rowe Price. There's a lot of different investment companies out there that are running these 529 plans, so that might be a factor in your choice. We provide a lot of tools on savingforcollege.com that allow you to compare 529 plans. And so you can go into our plan comparison tool and look for specific features of plans and how they essentially compare against each other. You can look at investment performance rankings that we come out with every quarter. So we have a methodology where we go in and look at specific portfolios or investment options in each 529 plan, and then we compare that performance to other 529 plans, and we come out with a report that ranks the performance over 1 year performance or 3 years or 5 years or 10 years. So that might be helpful to you as well. And of course, fees and expenses are important too. So make sure you understand the level of fees and expenses in your 529 plan and whether you're getting a low cost 529 plan versus a high cost plan.
And can you touch on the different types of investment options that are typically offered in a plan?
Sure. Just about every 529 plan offers what's known as an age-based investment option, and that's the most popular option because that's where the plan will invest your dollars based on the age of your child and how long it is before your child attends college. And so while your child is young, the account is invested primarily in stocks, which are higher risk but potentially higher return. But as your child gets closer to college age, you don't want to take all that risk of the stock market, so the account automatically shifts to more bonds or money market fixed income type investments that have lower risk. So it's an approach that makes sense. It's very easy for you as an account owner because you don't have to do anything. All these account allocations are made automatically for you each year, and it works. It helps protect accounts. I've had 529 accounts for our 2 kids, and they went through both of the stock market recessions of 2002 and 2008. Those age-based accounts held up very well for them during those time periods, and they happened to be going to college during those time periods too. So I was very pleased with the age-based investment option. If you don't want the age-based option, then you also have options in most 529 plans to choose what we call a static investment option. So if you want, let's say, just 100% stocks, and you know that's what you want, you can invest in that particular option in your 529 plan, or 100% money markets, if that's what you want, ultra conservative. You can find that in 529 plans. So you have that choice.
Okay, and so we've kind of been talking a lot about the college savings plans. Can you talk about the difference between those plans and the prepaid plans?
Yes, they're very different. College savings plans and prepaid tuition plans, they're both 529 plans. So you get the same federal tax treatment when you take the money out of those plans, but they work very differently. So your 529 savings plan works like your IRA or your 401k. You make contributions to the account. Those contributions get invested in underlying investments, and then over time, the value of your account depends on the performance of those underlying investments. So hopefully, those investments will do well over time, and your account will grow. And then you simply take money out of the account when it comes time to pay college bills. The prepaid tuition plans are essentially a contract between you and the state. So for an amount of money, you purchase a contract, and the state now is liable or responsible for paying the agreed amount of tuition for your child. So it's a way for you to pay now for future tuition that becomes the responsibility of the plan to pay. So it's sort of a hedge against tuition increases in those states. Now, very few states actually offer prepaid tuition plan anymore. I believe it's under 10 states, and those states generally require that you be a resident of that state to get into their prepaid tuition plan. There is an exception out there. There is a plan for private colleges called the Private College 529 plan, and so that plan includes, I think, over 300 private colleges around the country. If you invest in the private college 529 plan, then you're basically guaranteed to keep up with tuition at any of those colleges if your child ends up attending that college or one of those colleges. If they don't attend one of those colleges, then you're sort of limited on how much the plan will pay you in dollars to go someplace else, although there is still some upside potential in that particular plan.
Okay. We'll take another question from Tony. He asks, do 529 owners only have to report non-qualified distributions on their tax returns? So if all distributions were qualified, would you have to provide proof to the IRS?
No, that's exactly right, Tony. It's only non-qualified distributions where you figure out how much has to be reported as income. That income gets reported on your tax return. If it's all tax-free, you don't report anything on your tax return because it's tax-free. The IRS could come back and say, well, we know you received a 1099, you didn't report anything on your tax return. You have to provide substantiation of college expenses of your beneficiary in order for us, the IRS, to be satisfied that it is truly tax-free. So it's much like charitable contributions that you report on your tax return. You have to keep documentation of your college expenses in case the IRS comes back and asks for that documentation. As I said before, you know, the 1099 goes either to the beneficiary of the account or to the account owner, depending on who you make that distribution payable to coming out of the 529 plan. In my experience, a 1099 that goes to the beneficiary, the IRS tends to be okay with nothing showing up on the beneficiary's tax return. I've never heard of it being questioned. However, if the 1099 goes to the account owner, it happens very frequently that the IRS will send out a notice saying you owe additional taxes and interest because you didn't report the earnings on your tax return. I've had that myself because I've taken some distributions. They're tax-free. I did everything right. I didn't have to report it on my tax return, but now the IRS is telling me that I did it wrong, and I have to provide documentation to the IRS. So one suggestion I often give is, if you can, have the distribution made payable to your child, even though it shouldn't make any difference in the end.
Okay. Let's talk for a second about grandparents. We got a couple questions submitted having to do with grandparent-owned 529 plans. And Harry asks if you can go over the top reasons to and the top reasons not to fund 529 plans for your grandchildren.
Well, the reason to fund 529 plans for your grandchildren is because you can. It gives you all the tax benefits of a 529 plan, tax-free growth, maybe some state tax deductions. On top of that, another huge benefit with 529 plans is that the account owner always controls that account. The beneficiary never gets their hands on that money unless the account owner tells them that they can have their hands on that money. So this is very different than the Uniform Gift to Minors Act accounts or Uniform Transfers to Minors Act accounts. Those have been used for years and years and years to make gifts to children that are invested. The problem with those UGMA or UTMA accounts is that at a certain age, under the state law, the child gets their hands on that money. It becomes theirs, and they can spend it any way they want to. With 529 plans, that doesn't happen. So the grandparent can be confident and rest assured that the money won't be spent recklessly by the child. The parent can also have that assurance. So it works out very nicely from that perspective. Grandparent 529 accounts are treated much differently for financial aid purposes than parent-owned 529s. Grandparent assets, whether they're 529 plans or anything else, are never reported on the application for financial aid. So they don't count, which is good. The problem is that any financial support that comes from a grandparent or other third party like an aunt or an uncle, that financial support has to be added back to student income on the financial aid application. And that income, as I said before, is assessed at a very high rate, 50%. So even though the asset doesn't get counted, the use of that 529 plan or any other financial support provided by a grandparent has to be added to the student's financial aid income, not the taxable income, just the financial aid income. But as I said, that can hurt. So grandparents may not, in fact, want to own their 529 account. They may be better off having the parent own the 529 account. So that's a case-by-case basis. You have to look at whether the grandparent wants to control that 529 account or not. If they don't really feel a need to control the account, my suggestion in a lot of cases is either shift the ownership of that account to the parent or simply make contributions to an account that the parent already owns instead of making contributions to your own account. 529 plans are great for grandparents that are doing estate planning because the 529 account comes out of your gross estate. The fact that you can continue to control that account is unique. There's no other way to remove assets from your estate and retain control. So that's something that the estate planning attorneys will hopefully be very familiar with and help you if you're doing estate planning.
Okay, now Jeff asks, what's the best way for a parent to start a 529 when the grandparent has already started one?
That's a great question. You can have separate accounts for your beneficiary. So one child could have accounts from parents, from one set of grandparents, and from another set of grandparents, and from there could be all sorts of accounts floating around for a particular child, which is fine. Until the child gets to college, and then there really has to be some sort of coordination of, whose money are we going to use to pay for the child's college education. So I think there really has to be some communication between family members. The parents and the grandparents should talk about their goals for education funding, whether the grandparents want to chip in, and the best way to chip in, and who should be owning the account, who should be controlling these 529s. You really do need to lay out a game plan, because you just don't want to get to the end there, to the college years, and then find out that it becomes a problem, that communication hasn't worked well, or someone's passed away, or whatever. That's really the key, Kathryn, is just to get everybody together and make sure that you're talking.
Okay, and that's a good leader to the next question from Joanna. You mentioned that family and friends can contribute as well, so how does that work?
Family and friends can simply make contributions to an account that, let's say, the parents set up. Most 529 plans even have an easy way to do that. If you go to their website for the 529 plan, they may have a special friends and family program that'll take you through the steps of putting money into a child's 529 account. And there could even be special social media connections, all that sort of thing that goes along with it. If you don't want to go through all that and just want to make a contribution and not have to worry about going to a website or finding out, which 529 plan the parents are using. What you can do is just simply write out a check. Say tell the parents you want to help. Ask them, which 529 plan are you using? Write out a check in the name of that 529 plan, and then just hand it over to the parents and let the parents deposit that check for you. So that's gonna get it in there. Whether or not you'll be eligible for a state tax deduction, you have to look at the rules in your particular state. Some states do require that you be the account owner in order to get a deduction for your contributions. So you really have to check on that.
Okay, great. So Jeff wants to know, going back to grandparents, what would be a solution for the grandparent 529 when the grandparent becomes deceased?
Well, when you set up a 529 account, you're asked to name a successor owner. So if something happens to you, you die or become, incompetent or disabled, then the successor owner can take over that account for you. That successor owner essentially steps into your shoes. and makes all the decisions on that 529 account going forward. So you have to, be careful and think about who you want to be the successor owner of your account. If you're the grandparent, the natural choice would be the parent of that child, of the grandchild. But if you don't really even trust the parent to do the right thing, you might either make the child the successor owner. Of course, if the child is a minor and you pass away, then that child won't be able to make decisions on their own regarding the account. There'll be a guardian or a custodian for the child that will make those decisions, but it has to be in the child's best interest at that point. So either the parent or the beneficiary. In some cases, you can even set up a trust and make the trust the successor owner. And that way you can tell the trustee exactly how to handle that account, because it becomes part of the trust document that you have drafted by your attorney.
Okay. So Karen has a question about scholarships. If a student receives a 4-year scholarship, must you take the amount equivalent to that year's scholarship out the same year as it is received from the school to receive the tax-free treatment? Or she's asking, can you leave the amount equivalent to the scholarship in the 529 and take it out any time in the future tax-free?
That's a great question, but it won't come out tax-free. If you don't have qualified expenses and you take the money out of the 529, it's taxable. So we're really only talking about the penalty exception here, the exception for scholarships, so you don't have to pay that extra 10% tax on the distribution. And the way I read it is there's no set timeline for taking your money out of a 529 plan and claiming that exception for scholarships. So if you wait until your child is done with college and you find that you have money left over in the 529, you should go back to their college career and count up all the tax-free scholarships that they received during their career, and that is the amount that I believe you can claim as a waiver to the 10% penalty. So you don't have to do it in the same year as the scholarship was received. Now, that's different than actually taking money out tax-free from your 529 plan against your qualified expenses. You do have to take qualified distributions in the same year that you pay those expenses. So for any particular calendar year, when you take money out of a 529, make sure you have enough expenses during that calendar year to cover the amount that you've taken out of your 529. Don't wait until January to take the money out of your 529 to reimburse yourself for a tuition bill that you paid in December, because now you're in different years and that December payment no longer can be counted against your January distribution. So watch out for that.
Okay. Question about accounts from Laura. Can I open one 529 plan for my 2 children, or do I have to open 2 529 plans?
You don't have to open 2 529 plans. You can open just one account. You can only name one beneficiary, so you'd have to choose which child is the beneficiary in that account. But anytime in the future, you can change the beneficiary in that account, or you can split that account into 2 accounts, each having a different beneficiary. So you do have that flexibility to open one account now and then use it for both children in the future. I typically suggest setting up separate accounts, though. It's not that much harder to set up separate accounts. There's a little more paperwork involved. But this way you keep everything, all the records in place. You know what you're doing for each child. If your children are different ages and you're using the age-based options, then you'll be able to select the age-based option that's appropriate to each child based on their age. Also, opening up separate accounts or multiple accounts will give you more gift tax leeway. The contributions that you make to a 529 plan are considered gifts for gift tax purposes, and you have $14,000 per year that you can make in gifts without those gifts becoming reportable gifts. So if you have just one account, then you're pretty much stuck with that $14,000 limit for that particular year. If you're opening up separate accounts for different children, then you can multiply that $14,000 by 2, let's say, and you can make up to $28,000 without having to worry about gift tax forms. So for that reason too, I would open up separate accounts.
Okay, and I think we got another follow-up question regarding the scholarships, but I think you just answered it. It's from Jeff. He says, if you don't spend all of the money because of scholarships, could you change the beneficiary to another child or relative?
You absolutely can. Yeah, there's no one that is forcing you to take the money out of a 529 plan at any time. If the beneficiary has graduated from college, there's nothing to prevent you from just keeping any excess funds in your 529 account. Maybe that beneficiary will go back to graduate school and you want to use it for that, or at any time in the future you can change that beneficiary to another family member. One of the advantages of 529 plans is that there are no time limits on the account. So as long as there is a family member named as beneficiary on that account, you can keep that account open for as long as you want to, even over multiple generations. I mean, we may potentially see 529 accounts that last for not just dozens of years, but for decades or even hundreds of years. It's theoretically possible to have that happen and benefit multiple generations of a family just by changing the beneficiary at different times.
Yeah, that's really cool. So can the beneficiary and the account owner be the same person?
Well, yes, they can. You can set up a 529 plan for yourself and possibly use it if you want to return to school later on in life. Maybe you want to go and take some classes at a community college and want to use a 529 plan to save for that. And I know about that because I'm back in school myself at community college, and I'm using my 529 plan to help pay for that. So it's a great way to save for future college expenses as an adult. It's also a way to set up an account with maybe the intention of changing beneficiary later on. I see this once in a while with grandparents. A grandparent may have 20 different grandchildren that he or she wants to set up 529 accounts for, but now they have to run around and get social security numbers for all these grandchildren. They really should talk to the parents of all these grandchildren and make sure that the communication is in place and they're all thinking along the same line. That can take time. So maybe a grandparent just wants to set up an account, name themselves as beneficiary when they open the account, and then once they sit down with everyone and get their plan in place, they can go ahead and change beneficiary and split that account out to all the different grandchildren. So that's definitely possible. We also see parents that don't even have a child yet, but they expect to have a child in the future, and they want to get started right now on saving for college for that unborn child. They can do that by setting up the account in one of their own names as beneficiary, and then once the child is born, then changing the beneficiary at that time.
That's great. Why don't we move on to talk a little bit about the ABLE Act, which was signed into law in early December. ABLE stands for Achieving a Better Life Experience. We have a couple of questions regarding this act. So Joe, if you can just touch on the ABLE Act and what it is and what it means for current 529 holders, and then also, are there any states that currently have ABLE Acts to date?
Well, first off, ABLE Act really doesn't have any impact on current 529 holders. ABLE is basically a completely new tax-free savings account for families with a disabled individual. And Congress came along with this idea to help these families save for future expenses for that individual, and they looked at 529s as the model for this type of savings account. So they're actually called 529A accounts, and they depend on states opening up these investment programs under the ABLE Act. No state has done that yet. As you mentioned, the legislation is only, or the law is only a couple months old at this point. So it's up to the state to actually start these ABLE programs, these investment programs, and make them available to families for their disability needs. There's a lot of technicalities that go along with these ABLE accounts. They're different from 529 savings accounts in many ways. They have lower limits on contributions to these ABLE acts or these ABLE accounts. What they can be used for is an entirely different list of items, since it doesn't necessarily include college. So there's certainly some excitement and anticipation of having this new investment vehicle for disabled individuals that somehow helps when you look at current ways to use public funds for these individuals. But we'll have to wait, and we may be waiting a long time, to be honest with you, before we see any of these accounts come to fruition.
Okay, well, we'll definitely keep everyone posted on that. I think that's all the questions we have for today. Joe, is there anything you want to leave our guests with?
Well, I think that anyone who's listening here today, you're probably already using 529s, or you're already interested in 529s. I hope that through all this hoopla with President Obama over the last week or so, we've convinced a lot of families that 529s are indeed the best way to save for college in most situations, and that you'll make the effort to start setting aside money in 529 plans, even if it's only a few dollars a month. At least that's getting you going, and you always have the opportunity in the future, if your financial circumstances allow, to increase your contributions and ultimately to be able to better afford a college education for your child or your grandchild. So I appreciate the opportunity to be here today, Kathryn, and all these great questions that came in.
Well, thanks again, Joe, and thanks to everyone else for joining us. If anyone has additional questions, you can visit savingforcollege.com, and we have a message board where you can ask any questions and someone will get back to you. Thanks again.